Before we begin, a quick and important disclaimer. The following content is for educational and entertainment purposes only and does not constitute professional legal, financial, or insurance advice. While we will be analyzing historical trends and statistical data regarding wealth distribution and marital dissolution in the United States, every individual's financial situation is unique. You should conduct your own due diligence and consult with licensed professionals, such as family law attorneys or certified financial planners, before making any decisions regarding your assets or insurance coverage. In the next 10 minutes, a couple in the United States will sign a document that effectively liquidates 50% of their lifetime earnings, resets their retirement clock by 15 years, and triggers a taxable event so massive it rivals a corporate bankruptcy. By the time this video ends, roughly 35 more American households will have entered a financial freefall from which many will never fully recover. We are taught to hedge against house fires, which have a 1 in 3,000 chance of occurring. We are told to buy car insurance for a fender bender that might happen once a decade. Yet, we almost entirely ignore the statistical reality that a primary driver of middle-class wealth destruction in America isn't the stock market crashing or a medical emergency. It is the dissolution of the marital estate. We are looking at a historical trend where the standard American wealth-building model is being systematically dismantled by a lack of risk management for the one event that has a nearly 50% probability of happening. This is not a video about heartbreak. This is a deep dive masterclass into the cold, hard mathematics of wealth loss and the emerging, controversial economic framework known as divorce insurance. Today, we are solving the blind spot problem. Most Americans operate under a financial survival bias, assuming their portfolio is safe because they have diversified their stocks. But they have failed to diversify their liabilities. This video will provide you with a comprehensive understanding of how marital dissolution functions as a catastrophic financial event, and why the historical data suggests that traditional prenuptial agreements may no longer be sufficient for the modern economy. You will learn how the divorce tax has evolved over the last 60 years, the hidden costs of legal friction, and why the insurance industry is beginning to view the end of a marriage not as a moral failing, but as a predictable, quantifiable, and insurable risk. To understand why we even need to discuss the concept of divorce insurance, we have to look at the sheer scale of the historical wealth erosion. If we look back at the post-World War II era, marriage was often a mechanism for wealth consolidation. Two incomes, one household, shared expenses, and tax benefits created a marriage premium. However, as the legal landscape shifted toward no-fault divorce in the 1970s, the economic trajectory changed. We began to see the divorce penalty emerge in the data. According to longitudinal studies from the U.S. Census Bureau and various academic institutions, the immediate aftermath of a marital split results in an average drop in household income of roughly 25 to 40% for the lower-earning spouse. But more importantly, it results in a massive fragmentation of the cost of living efficiency. Consider the dual household trap. When a single economic unit splits into two, the cost of maintaining the same standard of living does not just double. It scales exponentially due to the loss of shared resources. You now have two mortgages or rent payments, two sets of utility bills, two sets of groceries, and a loss of the economy of scale that allows a family to thrive. Historically, the U.S. legal system was designed to divide existing assets, but it was never designed to protect future growth. This is where the concept of opportunity cost becomes the silent killer of wealth. If a 35-year-old individual loses $100,000 in a settlement, they aren't just losing that cash. If that money was invested in a standard index fund with an average 7% return, that $100,000 would have been worth approximately $760,000 by the time they reached 65. The divorce didn't cost them six figures. It cost them nearly $750,000 in retirement security. Let us examine a case study that illustrates the legal friction coefficient. In a standard contested divorce in a major U.S. metropolitan area, legal fees can easily range from $15,000 to over $100,000 per person. When you add in the costs of forensic accountants, child advocates, and real estate appraisers, the transactional cost of ending the marriage can eat between 10 and 20% of the total net worth of a middle-class family. In the world of finance, if an investment had a 50% chance of losing 20% of its value just in transaction fees, no fiduciary would ever recommend it. Yet, this is the default setting for the American dream. This brings us to the core of our deep dive: the statistical justification for divorce insurance. In any other sector of the economy, when a risk reaches a certain threshold of frequency and severity, an insurance product is born. We have key person insurance in business to protect against the loss of a CEO. We have business interruption insurance for when a factory burns down. Divorce insurance or marital dissolution indemnity functions on the same principle. It is a casualty product designed to provide a cash benefit upon the finalization of a divorce, specifically to offset the legal costs and the immediate loss of equity in a primary residence. Historical trends show us that the greatest period of wealth vulnerability occurs in the first 24 months following a separation. This is known as the liquidity crunch. Most marital wealth is tied up in illiquid assets, homes, 401ks, and vehicles. When a court orders an equitable distribution, individuals are often forced to sell these assets at the worst possible time, perhaps during a housing market dip or a bear market, just to generate the cash required to pay out a spouse or cover legal retainers. Divorce insurance is proposed as a way to provide bridge liquidity. Instead of selling your shares of a tech stock while they are down 15%, the insurance payout covers the immediate costs, allowing the principal investment to stay in the market and continue compounding. We also have to address the pension and Social Security gap. In many states, retirement accounts are considered marital property. A spouse who has worked for 20 years at a firm may find their pension or 401k halved overnight. This isn't just a loss of money, it's a loss of time. A 50-year-old cannot re-earn the 20 years of compound interest they just surrendered. The data suggests that divorced individuals are significantly more likely to live in poverty during their elder years compared to those who remained married, or even those who remained single their entire lives. The disruption of the wealth trajectory is so severe that it becomes a multi-generational issue, often depleting the funds that would have otherwise gone toward children's college educations or an inheritance. By treating the end of a marriage as a statistical event rather than a personal failure, we can begin to apply modern risk management tools. Throughout this series, we will break down the actuarial tables of matrimony, looking at how age, income level, and geographic location influence the risk rating of a household. We will look at how the modern U.S. economy, characterized by high debt-to-income ratios and volatile housing markets, has made the traditional split, everything down the middle, approach a recipe for financial insolvency. We are moving toward a future where financial marriage prep isn't just a prenuptial agreement written by lawyers, but a comprehensive insurance strategy designed to ensure that if the household unit fails, the individuals involved don't end up in a cycle of debt and poverty. This is the new reality of American wealth preservation. To truly understand the necessity of divorce insurance, we must dissect the mechanics of what sociologists call the divorce shock. It is 2026, and the average American middle-class family has their wealth concentrated in three specific buckets: primary residence equity, retirement accounts, and future earning potential. When a marital dissolution occurs, these buckets aren't just divided, they are often shattered. We are going to look at the case study of a hypothetical but statistically representative couple, David and Sarah, living in a suburb of Austin, Texas. David is a software project manager, and Sarah is a senior marketing director. Combined, they earn $240,000 a year. They own a home worth $650,000 with $250,000 in equity, and they have a combined 401k balance of $400,000. On paper, they are the success story of the American dream. However, the moment the legal process begins, their $650,000 net worth enters a state of high-velocity erosion. Imagine if you were told that a major financial event was about to occur where you would lose 30% of your assets to administrative costs alone. In the U.S. legal system, the first leak in the bucket is the retainer. In 2026, top-tier family law firms in metropolitan hubs require upfront retainers ranging from $10,000 to $25,000 per person. This is liquid cash that usually comes out of emergency savings, the very capital meant to provide a safety net during transitions. For David and Sarah, $40,000 of their liquid cash vanishes before a single motion is even heard in court. But the legal fees are just the tip of the iceberg. The real destruction happens in the forced liquidation of assets. Let us look at the house. In a stable marriage, that $250,000 in equity is a stagnant, growing hedge against inflation. In a divorce, the court often requires the marital home to be sold to facilitate an equitable distribution of proceeds. When David and Sarah sell their home under the pressure of a court-mandated deadline, they are subject to the 6% realtor commission, which is $39,000, plus closing costs and repair credits, totaling roughly $50,000 in lost equity. They have just paid a $50,000 tax simply to access their own money. This is a historical trend that has wiped out the generational wealth of millions of American families. If they had divorce insurance, a supplemental policy could have provided a cash payout to one spouse to buy out the other's equity, allowing the family home to stay in the portfolio and continue to appreciate. Now, let us move to the second bucket, the retirement accounts. This is where the compounding interest curve is brutally flattened. Under a Qualified Domestic Relations Order, or QDRO, David's 401k is split. While the transfer itself is generally a non-taxable event if handled correctly, the long-term impact is devastating. By splitting a $400,000 balance into two $200,000 accounts, you aren't just dividing the money, you are losing the power of the larger principal to weather market volatility. Furthermore, the administrative fees for drafting a QDRO can cost thousands of dollars per account. Historically, data shows that individuals who split their retirement assets at age 45 have a 65% lower chance of reaching their original retirement goal by age 65. They are forced to increase their risk profile, chasing higher returns in volatile markets to make up for the lost principal, which often leads to even greater financial instability. The third bucket, future earning potential, is perhaps the most complex and least understood. In the U.S., the concept of alimony or spousal maintenance is designed to bridge the gap for a lower-earning spouse. However, from a statistical wealth loss perspective, this functions as a massive long-term liability for the pair and an unstable income stream for the payee. If David has to pay $3,000 a month in maintenance for 5 years, that is $180,000 of his future post-tax income gone. For Sarah, while she receives the cash, she loses the tax advantages of the dual filing status and the shared household efficiencies. Both parties end up with less discretionary income to invest in the stock market or real estate. This is why the concept of divorce insurance is gaining traction in 2026. Traditional insurance is based on the law of large numbers. It assumes that if you pool the risks of a large group of people, you can provide a safety net for the few who experience a catastrophic event. Given that the U.S. divorce rate has historically hovered near 40 to 50% for first marriages and even higher for second marriages, the actuarial risk is high, which is why these policies are structured as long-term casualty products. They aren't meant to be get-rich schemes. They are designed as a wealth floor. Imagine if David and Sarah had a policy that cost them $50 a month starting from the first year of their marriage. By year 10, if they face a dissolution, the policy triggers a $50,000 lump sum payment. This cash does not go toward a vacation. It goes toward the friction costs. It pays the realtor commission so the equity stays intact. It pays the QDRO attorneys so the retirement accounts can be split without draining the savings. It provides the relocation capital, so neither spouse is forced to put a security deposit for a new apartment on a high-interest credit card. Historically, the cycle of debt starts in the first 6 months of a divorce because of a lack of immediate liquidity. Divorce insurance creates a liquidity buffer that stops the downward spiral before it starts. The data also points toward a psychological phenomenon known as scarcity brain. When individuals are under extreme financial stress during a legal battle, they make poor long-term decisions. They might settle for a smaller portion of a pension just to get the process over with, or they might take on a high-interest personal loan to pay their legal counsel. These panic decisions have a cumulative effect on a person's net worth that can last decades. By removing the immediate financial panic through an insurance indemnity, individuals can approach the legal dissolution of their marriage with a wealth preservation mindset, rather than a survival mindset. Historical trends in the U.S. show that women, in particular, suffer a disproportionate amount of wealth loss following a divorce. Statistics from the past 3 decades suggest that a woman's standard of living can drop by as much as 45%, while a man's may actually see a slight increase or a much smaller dip. This disparity is often due to the caregiving penalty, where one spouse has stepped back from the workforce. Divorce insurance acts as a form of human capital protection. It acknowledges that the years spent out of the workforce have a quantifiable dollar value, and provides the capital necessary for retraining or re-entering the professional market at a competitive level. But what about the moral hazard? Critics often argue that having insurance against divorce makes it easier to quit. However, historical data from other insurance sectors, like fire or auto, shows that having insurance doesn't make people want to crash their cars or burn their houses down. In fact, by reducing the financial toxicity of a relationship's end, you may actually reduce the conflict levels, which in turn reduces the total legal spend. When the financial stakes of the split are de-risked, the process becomes less about winning and more about restructuring. We are looking at a fundamental shift in how Americans view the marriage contract. Historically, it was a social and religious bond. In the 20th century, it became a legal bond. In 2026, it is increasingly being recognized as a massive financial merger. And like any merger between two multi-million-dollar entities, it requires a sophisticated risk mitigation strategy. If you wouldn't run a business without insurance, why would you run a household, the most important business of your life, without a hedge against its most likely point of failure? But there is a darker side to the statistics that we haven't touched on yet. While legal fees and housing are visible costs, there is a hidden tax trap that catches almost everyone off guard. Depending on how the assets are divided and when the final decree is signed, the IRS can become the third party in your divorce, taking a significant cut of the settlement that neither spouse accounted for. In the next part, we are going to dive into the Internal Revenue Code Section 1041 and the hidden tax liabilities of divorce that can turn a seemingly fair 50-50 split into a 70-30 nightmare. We will also explore the actuarial reality of why some marriages are statistically uninsurable and how you can determine if you are in a high-risk category before you ever walk down the aisle. The numbers don't lie, and they are about to get much more intense. The numbers don't lie, and they are about to get much more intense as we step into the shadow of the Internal Revenue Service. Most people assume that if a judge orders a 50-50 split of assets, they are walking away with exactly half of the value. This is a mathematical fallacy that has decimated the net worth of countless Americans over the last several decades. We have to look at the concept of the tax-adjusted basis. Imagine a character named Marcus, a senior engineer at a major aerospace firm in Seattle. It is 2026, and Marcus is navigating a dissolution. The marital estate has two primary assets of seemingly equal value: a brokerage account worth $500,000 consisting of high-growth tech stocks, and $500,000 in home equity. In a standard negotiation, Marcus might take the $500,000 in stocks while his spouse takes the $500,000 in home equity. On the surface, this looks like a perfect parity. But look closer at the historical trends of capital gains. The stocks Marcus inherited have a cost basis of $100,000, meaning they have $400,000 in unrealized gains. When Marcus eventually sells those stocks to fund his new life or retirement, he will be hit with a massive capital gains tax bill. Conversely, his spouse, utilizing the Section 121 exclusion on the sale of a primary residence, may be able to pocket up to $250,000 of gain entirely tax-free. Marcus didn't get half. He got half minus a six-figure future tax liability. This is the tax trap of Section 1041. While the transfer of property between spouses is generally non-taxable at the moment of divorce, the tax liability is a ticking time bomb that travels with the asset. This historical lack of tax awareness is a primary driver for why divorce insurance is being redesigned to include tax indemnity riders. Such a policy would provide a cash infusion specifically to offset the embedded tax liabilities of transferred assets, ensuring that a 50-50 split actually feels like 50-50 when the dust settles. Step by step, we have to look at how these tax implications ripple through other assets like restricted stock units and stock options. For many professionals in the modern U.S. economy, a huge portion of their wealth is not in a bank account but in unvested equity. Historically, the division of these assets is a nightmare of co-ownership, where ex-spouses remain financially tethered for years. If Marcus is forced to exercise his options and transfer the cash value to an ex-spouse, he is often the one stuck with the ordinary income tax hit on his W-2, potentially pushing him into the highest 37% tax bracket. He is paying taxes on money he never even got to keep. Divorce insurance acts as a hedge against this tax bracket creep, providing the liquidity to pay the IRS without liquidating the very assets that were supposed to provide for his future. Now let us pivot to the actuarial reality of who is actually insurable. In the world of insurance, risk is categorized by tiers. Just as a smoker pays more for life insurance, certain marital profiles carry higher statistical risks of wealth loss. Actuaries in 2026 are looking at several key data points: the duration of the marriage, the income disparity gap, and jurisdictional volatility. For example, historical trends indicate that the 7-year-itch is not just a cliché. It is a statistical peak in the frequency of filings. Marriages that pass the 10-year mark in many states trigger a shift in spousal support laws, moving from short-term rehabilitative alimony to long-term or even permanent support. This represents a massive shift in the risk profile of the higher earner. Consider a case study of a high-risk profile. Imagine if an individual in their late 40s is entering a second marriage with a significant wealth disparity. Statistically, second marriages have a failure rate closer to 60 or 67% in the United States. From an insurance perspective, this individual is in a subprime risk category. Traditional prenuptial agreements are the standard tool here, but they are often challenged in court as being unconscionable or signed under duress. This is where divorce insurance provides a layer of protection that a piece of paper cannot. While a prenup attempts to prevent the loss, the insurance policy acknowledges the potential for the loss and provides the cash to survive it. It is the difference between a seatbelt and an airbag. The seatbelt, the prenup, is designed to keep you in place. The airbag, the insurance, is there to absorb the impact when the structure fails. We also have to discuss jurisdictional volatility. In the U.S., your wealth is at the mercy of the state line you live behind. If you live in a community property state like California or Texas, the law generally dictates a strict 50-50 split of all assets acquired during the marriage. If you live in an equitable distribution state like New York or Florida, the judge has massive discretion to divide assets in a way they deem fair, which could mean a 60-40 or even 70-30 split. This unpredictability is a nightmare for wealth planning. Historical data shows that legal uncertainty is one of the biggest drivers of legal fees. When the outcome is uncertain, both sides spend more on lawyers to fight for a better equitable share. Divorce insurance policies are increasingly being priced based on the legal heat map of the United States. If you live in a litigious, high-discretion state, your premiums are higher because the statistical probability of a high-cost legal battle is elevated. Furthermore, we must analyze the lifestyle creep liability. In many U.S. jurisdictions, spousal support is calculated based on the standard of living established during the marriage. If a couple spent $20,000 a month on travel, luxury cars, and fine dining, the court may attempt to maintain that lifestyle for the lower-earning spouse. This creates a permanent wealth drain on the payer. Historical trends show that many high earners end up working well into their 70s not because they want to, but because they are legally obligated to fund a lifestyle they no longer participate in. Divorce insurance can be structured as a lump sum buyout hedge. If a policyholder is hit with a massive monthly alimony obligation, the insurance payout can be used to offer a single payment settlement, effectively buying out the future liability at a discount and allowing both parties to move on with a clean break. But what happens when the marriage is uninsurable? In 2026, insurance companies are beginning to use behavioral analytics and credit modeling to deny coverage. If an individual has a history of multiple short-term marriages, or if there is a pattern of significant undisclosed debt, they may find themselves unable to secure a policy. This is creating a new social hierarchy of financial stability. Being insurable for marriage is becoming a badge of financial health, similar to having a high credit score. It suggests that your financial life is transparent and that you are a low-risk partner. This brings us to the shadow costs of divorce that no one talks about. The impact on credit capacity. When you divorce, you often close joint accounts, refinance homes, and take on new individual debt. Historically, this leads to a significant drop in credit scores for both parties. A lower credit score means higher interest rates on future mortgages, car loans, and business ventures. For a business owner, a divorce isn't just a personal matter. It can trigger default clauses in business loans or buy-sell agreements that force them to sell their company at a fraction of its value. This is collateral wealth damage. Divorce insurance acts as a credit shield, providing the capital to pay down joint debts immediately so that the individual credit profiles remain untarnished. We are seeing a revolution in how the U.S. middle class protects its future. We have moved from a culture of for better or worse to a culture of for better, but hedged against the worse. But there is an even deeper level to this statistical story. What happens when the divorce isn't just between two people, but involves a family business or an inheritance that was supposed to be protected? In the next part, we are going to explore the inheritance leakage phenomenon and how separate property often becomes marital property through the process of commingling. We will look at how the lack of a divorce hedge can lead to the loss of a family legacy that took 3 generations to build. If you think your inheritance is safe because your name is the only one on the account, you are standing on a statistical landmine. We are going to show you how to defuse it. The statistical landmine of inheritance leakage is one of the most misunderstood aspects of American wealth management in 2026. Most people operate under the assumption that an inheritance is inherently separate property. They believe that if their parents or grandparents worked for decades to leave them a legacy, that legacy is protected by law. Historically, that is partially true, but the reality of the U.S. legal system is that separate property is a fragile state. It is like a drop of ink in a bucket of water. The moment it is mixed, the original form is lost forever. This process is known as commingling, and it is the primary reason why family legacies disappear in a single generation. Let us look at the case study of Elena, a graphic designer in Chicago. In 2026, Elena inherited $300,000 from her late father. She was married to her husband, Mark, at the time. To be responsible, Elena used $100,000 of that inheritance to pay off the remaining mortgage on the family home. She put another $100,000 into a joint brokerage account to save for their children's college education, and she kept the final $100,000 in a savings account in her name only. On the surface, Elena was being a team player. However, from a statistical wealth loss perspective, she just initiated a massive transfer of value. By paying off the mortgage on a marital home, Elena took separate, protected funds and converted them into marital equity. In the event of a dissolution, she likely cannot get that $100,000 back. The court views it as a gift to the marriage. By putting the second $100,000 into a joint account, she effectively surrendered ownership. Even the $100,000 in her private account is at risk. If she ever used marital income, the salary she earned during the marriage, to pay for fees on that account, or if she transferred small amounts in and out of it for household expenses, a skilled forensic accountant could argue that the entire account has been commingled. This is the inheritance leakage phenomenon. Historically, about 20% of all marital assets in high net worth cases involve some form of disputed inheritance. Divorce insurance in this context serves as a legacy hedge. While the insurance cannot stop a judge from declaring an asset commingled, it provides a cash indemnity to the beneficiary to replace the lost value of the inheritance. If Elena had a legacy rider on her policy, and her $300,000 inheritance was deemed marital property and split 50-50, the insurance would trigger a payout to help restore her original position. This is vital because statistically, an inheritance is often the only windfall capital a middle-class person will ever receive. Losing it is not a temporary setback. It is a permanent reduction in their family's multi-generational economic standing. Next, we must examine the concept of transmutation. This occurs when the character of an asset changes over time. Imagine a scenario where one spouse owns a small business before the marriage. Let us call him Julian. In 2026, Julian's boutique consulting firm is worth $1 million. He marries, and over the next 10 years, the business grows to $5 million. While the original $1 million might be considered Julian's separate property, the $4 million in growth is often considered a marital asset because his active effort during the marriage contributed to that growth. This is the appreciation trap. Julian didn't just lose half of his business, he lost half of the value he spent the best years of his life building. Historical trends show that business owners are among the most vulnerable to wealth loss during a divorce because a business is often the most illiquid asset. If Julian doesn't have the cash to buy out his spouse's $2 million share of the growth, he might be forced to sell the company or take on a predatory high-interest loan. Divorce insurance can be structured to cover business valuation disputes and provide the liquidity for a buyout. Without it, the business, the engine of his wealth, could be dismantled. This is why many venture capital firms and private equity groups in 2026 are beginning to require key man divorce insurance for founders. They realize that the greatest risk to their investment isn't a competitor. It is the founder's personal life impacting the cap table. We also need to look at the step-up in basis and passive versus active appreciation within the American tax code. If an asset appreciates passively, like a piece of raw land that just sits there, it is more likely to remain separate property. But if one spouse spends even a few hours a month managing a rental property or renovating a house, that property can be transmuted into a marital asset. The data suggests that most Americans do not keep the rigorous, decade-long logs required to prove an asset remained passive. This lack of documentation is a statistical certainty that leads to wealth erosion. Imagine if you had to prove every dollar you spent and every hour you worked for the last 15 years to save 50% of your net worth. Most people would fail. This is where the educational value of divorce insurance becomes clear. It forces a financial audit at the inception of the policy. To get covered, you have to document your separate property clearly. This creates a paper trail that can be invaluable in court. Even if the policy never pays out, the act of maintaining the insurance creates a disciplined record of what was yours before the marriage, potentially saving you hundreds of thousands in legal fees and lost equity. Furthermore, we must address the dependency spiral. When a couple with significant wealth disparity divorces, the lower-earning spouse often lacks the credit history or professional network to maintain their lifestyle. They may have assets but no cash flow. Historically, this leads to the fire sale of jewelry, art, and even family heirlooms. This isn't just a loss of money. It is a loss of cultural capital. Divorce insurance provides an immediate cash stipend that allows the lower-earning spouse to transition without being forced into desperate financial moves. It preserves the asset base by providing a liquidity bridge. In the U.S., we are also seeing the rise of gray divorce, couples over the age of 50 splitting after decades of marriage. This is statistically the most devastating form of wealth loss because there is zero time for recovery. If you are 62 and you lose half of your nest egg, you cannot wait for the market to cycle back. You are forced into a permanent lower standard of living. For this demographic, divorce insurance isn't just a hedge, it is a retirement survival tool. It ensures that the longevity risk, the risk of outliving your money, is mitigated even if the household is divided. The historical data on wealth loss in the U.S. points to a singular conclusion. The legal system is a blunt instrument. It is designed for equity, not for efficiency. It does not care if you lose your family legacy or if your business goes under. It only cares about the division of the pie, as it exists on the day of the trial. Divorce insurance is the only mechanism that addresses the externalities, the taxes, the legal fees, the loss of compounding, and the emotional decision fatigue that costs families billions of dollars every year. But as we look deeper into the history of wealth loss, we find a pattern that is even more concerning than the loss of physical assets. There is a shadow economy of divorce that involves dissipation of assets. This is when one spouse, sensing the end is near, begins to hide, spend, or waste marital funds to prevent the other from receiving their share. In the next part, we are going to look at the forensic reality of asset dissipation. We will show you the red flags that actuaries use to identify high conflict risk, and how a new generation of smart contracts in 2026 is being used to create self-executing prenups that work alongside insurance to lock down wealth the moment a filing occurs. The battle for your net worth starts long before the lawyers are called, and you need to know where the front lines are drawn. The battle for your net worth begins in the quiet, undetected phase of asset dissipation. In the world of forensic accounting, this is known as the vanishing wealth phenomenon. Historically, by the time an individual realizes a marital dissolution is inevitable, a significant portion of the liquid marital estate may have already been diverted. In the year 2026, this does not always look like bags of cash buried in a backyard. It looks like sophisticated digital erosion. Imagine a character named Robert, a high-earning consultant in Miami. Robert senses the marriage is failing and over 18 months, begins a series of small, seemingly mundane financial moves. He makes overpayments to the IRS, knowing he can claim a refund on a solo return post-divorce. He prepays 3 years of country club dues. He invests in obscure, low-liquidity private placements that are difficult for a court to value or divide. This is the calculated dissipation of marital assets. Statistically, dissipation claims appear in approximately 15 to 25% of high-net-worth divorce cases in the United States. The challenge for the other spouse, let us call her Jennifer, is the cost of proof. To uncover Robert's prepayments and diverted funds, Jennifer must hire a forensic accountant at a rate of $400 to $700 per hour. The historical trend shows that unless the amount dissipated exceeds $50,000, the cost of the investigation often outweighs the potential recovery. This is a mathematical stalemate where the victim of dissipation loses simply because the system is too expensive to navigate. Divorce insurance in 2026 is evolving to address this through a forensic investigation rider. This feature provides the immediate capital necessary to hire top-tier investigators the moment a filing occurs, ensuring that the marital estate is frozen and accounted for before it can be siphoned away. We must also analyze the emergence of smart contracts and their integration with marital insurance. In 2026, we are seeing the first generation of self-executing prenuptial agreements linked to blockchain-based insurance policies. Imagine if your prenuptial agreement was not just a PDF in a lawyer's drawer, but a piece of code linked to your joint bank accounts and brokerage firms. If a petition for dissolution is filed, the smart contract triggers an automated hold on specific assets, preventing either party from liquidating the 401k or transferring large sums to offshore accounts. The insurance policy acts as the gas for this contract, providing the liquidity for the transition period while the assets are locked. This creates a level of financial security that was historically impossible, removing the Wild West element of early-stage divorce proceedings. The historical data on wealth loss also points to a significant risk factor: the emotional premium. In a study of U.S. divorce cases over the last 20 years, there is a direct correlation between high conflict and a decrease in the final retained net worth. Every angry email sent between lawyers costs $100. Every unnecessary court hearing costs $5,000. When one party uses the legal system as a weapon for emotional vindication, they are effectively burning their own money. This is why divorce insurance providers are now looking at conflict mediation incentives. Some policies offer a lower deductible or a higher payout if the parties agree to use collaborative law or mediation, rather than traditional litigation. This is an actuarial attempt to lower the loss ratio by incentivizing rational, low-friction behavior. Let us look at a case study involving the valuation gap. In 2026, many American families own non-traditional assets like cryptocurrency, specialized collectibles, or fractional shares in private startups. These are notoriously difficult to value. Historically, a husband might value a Bitcoin stash at its lowest point in a 6-month window, while the wife values it at its peak. They spend $20,000 in legal fees arguing over a $50,000 fluctuation. The valuation gap is the primary source of wealth leakage. Divorce insurance can provide an independent appraisal benefit, where a neutral third-party expert is funded by the insurance company to provide a definitive valuation that both parties agree to abide by. This removes the expert war that characterizes so many modern divorces. Furthermore, we need to address the debt contamination factor. In the United States, joint and several liability means that if your spouse runs up $50,000 in credit card debt on a joint account, the creditor can come after you for the full amount, regardless of what your divorce decree says. The divorce decree is a contract between you and your ex-spouse. It does not bind the bank. Historically, thousands of Americans have seen their credit ruined and their bank accounts garnished because an ex-spouse failed to pay a debt the court ordered them to pay. Divorce insurance can act as a debt indemnity shield. If a policyholder is forced to pay a debt that was legally assigned to their ex-spouse, the insurance pays out to cover the loss and then uses its subrogation rights to go after the ex-spouse for reimbursement. This puts the power of a multi-billion-dollar insurance company's legal department behind the individual. This leads us to the Social Security and derivative benefits history. Many Americans are unaware that if a marriage lasts 10 years or more, a lower-earning spouse may be entitled to Social Security benefits based on the higher earner's record. However, if the divorce happens at year 9 and 11 months, that entire lifetime benefit is lost. This cliff effect has massive long-term wealth implications. Actuaries are now designing products that top off retirement income for those who fall just short of these legal milestones. It is a way to hedge against the legal arbitrariness of the U.S. retirement system. Consider the housing market lock-in effect of 2026. With interest rates fluctuating, many couples are sitting on 3% mortgages from years ago. If they divorce and are forced to sell the house and buy 2 separate smaller homes, they might be moving into 7 or 8% mortgages. The interest rate differential over 30 years can cost each person hundreds of thousands of dollars in extra interest payments. They are essentially trading a cheap, shared debt for 2 expensive individual debts. Divorce insurance is now exploring mortgage rate subsidies as part of their payout packages, providing a cash lump sum intended to buy down the interest rate on a new post-divorce residence. This is a sophisticated way of preserving the purchasing power of the individual, not just their nominal net worth. The deep dive into the history of wealth loss reveals that divorce is the only unhedged risk in most Americans' portfolios. You hedge against your house burning down, though it likely won't. You hedge against dying early, though you likely won't. But you do not hedge against a 50% probability event that has a 100% probability of costing you at least a third of your net worth. The concept of divorce insurance is not a bet against the institution of marriage. It is a cold-blooded recognition of the economic friction inherent in the U.S. legal system. But even with insurance and smart contracts, there is a final, devastating wealth killer that often strikes years after the divorce is finalized. It is the modification trap. In many states, alimony and child support are never truly final. They are subject to material changes in circumstances. In the next part, we are going to look at the statistical nightmare of long-term support modifications. We will explore how an ex-spouse's promotion, or even their cohabitation with a new partner, can trigger a new round of legal battles that can last for years. We will examine the retirement trigger, and why many high earners find they are legally barred from retiring because of support obligations that were calculated based on their peak earning years. The shadow of the marriage can stretch for decades, and we are going to show you the math on how to finally step into the light. The mathematical reality of the modification trap is perhaps the most persistent drain on long-term wealth in the American financial landscape. To understand the magnitude of this, we have to look at the concept of ongoing jurisdiction. In the United States, a divorce decree is not a static document. It is a living contract that the state reserves the right to rewrite whenever a material change in circumstances occurs. This means that your financial liability to a former spouse is theoretically open-ended until a specific legal trigger, such as remarriage or death, occurs. For a high-earning professional in 2026, this represents a massive, unquantifiable liability that traditional financial planning almost entirely ignores. Let us look at the case study of Michael, a corporate executive in Charlotte, North Carolina. In 2021, Michael finalized his divorce. At the time, he was earning $350,000 a year, and the court ordered him to pay $6,000 a month in spousal support for 10 years. Michael factored this into his retirement plan, assuming he would be clear by 2031. However, in 2026, Michael receives a significant promotion, and his income jumps to $550,000. Under the laws of many states, his ex-spouse can file for a modification based on this increase in income. Suddenly, Michael is back in court, spending another $30,000 on legal fees to argue against an increase in support. This is the success tax of divorce. Historically, the more successful you become post-divorce, the more you are penalized by the open-ended nature of support modifications. Divorce insurance is now being designed with the modification defense rider. This specific feature does not necessarily pay the increased support, but it covers the legal costs of defending against a modification. In the U.S., the mere threat of a modification is often used as a tool for legal extortion, where one party settles for a higher monthly payment just to avoid the $50,000 cost of a full-blown evidentiary hearing. By having an insurance policy that pays for the defense, the policyholder levels the playing field, ensuring that modifications are based on actual law, rather than who has the higher appetite for legal fees. We must also analyze the retirement trigger. This is a statistical cliff that hits thousands of Americans every year. Imagine Michael wants to retire at age 62. His income will drop from $550,000 to a pension and Social Security draw of $120,000. He files a motion to terminate his spousal support because his ability to pay has fundamentally changed. However, the court may rule that his retirement is voluntary, and that he has the capacity to earn, based on his prior salary. Historically, there are cases where individuals have been forced to return to work or deplete their remaining retirement principal to satisfy support obligations that were calculated when they were at their peak. The data suggests that this alimony-induced career extension is a primary reason why divorced men in the U.S. have a significantly higher average retirement age than their married counterparts. They aren't working because they love the job. They are working to satisfy a court order. Divorce insurance acts as a hedge against this specific risk. A policy can be structured to provide a lump sum payment at the point of retirement, which can be used as a buyout offer to the ex-spouse. By offering a guaranteed cash amount today in exchange for a permanent waiver of future support, the retiree can secure their financial freedom and lock in their retirement date. Next, we need to address the cohabitation controversy. In 2026, the definition of a material change has expanded in many jurisdictions to include cohabitation. If an ex-spouse moves in with a new partner who contributes to the household expenses, the pair may be able to reduce or terminate support. However, proving cohabitation is a forensic nightmare. It involves private investigators, tracking bank statements, and proving economic interdependence. Historically, the cost of proving cohabitation can exceed $20,000. Most people simply don't have the liquid capital to chase this, so they keep paying support that they may no longer legally owe. This is where the investigative power of an insurance provider becomes a massive asset. Just as an auto insurance company investigates a suspicious claim, a divorce insurance provider with a cohabitation rider can deploy professional resources to verify the status of the payee. This shifts the investigative burden away from the individual and onto a corporate entity with the scale and expertise to handle it. It turns a personal, emotional conflict into a standard verification of policy eligibility. Beyond the support modifications, we must look at the cost of living adjustment or COLA trap. Many older divorce decrees in the U.S. include automatic increases based on the Consumer Price Index. In periods of high inflation like those seen in the mid-2020s, a support payment can grow by 5 to 8% a year. Over a decade, this can result in a payment that is 60% higher than the original amount, even if the payer's salary has remained stagnant. This creates a real income compression that can push a payer into debt. Divorce insurance products are now offering inflation hedges, providing supplemental payouts that trigger when CPI-based increases exceed a certain threshold. Step by step, the history of wealth loss in America shows that we have ignored the long tail of marital dissolution. We focus on the initial split of the 401k in the house, but we ignore the 20-year shadow liability that follows. For a business owner, this is even more dangerous. If a business owner is paying spousal support, the court effectively has a lien on their company's cash flow. They cannot reinvest in new equipment or expand their headcount as easily because a fixed portion of their profit is spoken for. Historically, this has led to the stagnation of thousands of small businesses across the U.S. Imagine if you were a CEO and you had a silent partner who took 20% of your profit but provided zero labor, zero capital, and zero strategic value. No investor would put money into that company. Yet, this is exactly the position many divorced entrepreneurs find themselves in. Divorce insurance provides the exit capital to remove that silent partner from the cap table. It allows for a clean break that preserves the growth engine of the business. The historical trends are clear. The U.S. legal system favors standard of living maintenance over wealth preservation. It is a system designed to look backward at what the couple had, rather than forward at what the individuals need to survive. As we move deeper into this masterclass, we have to look at how this systemic bias impacts the next generation. The educational wealth gap created by divorce is a statistical certainty that impacts college attendance rates and early career debt for children of divorced households. We are going to explore the concept of the child support delta, the gap between what the court orders and the actual cost of raising a child in a high-inflation 2026 economy. We will look at how divorce insurance is being utilized as a college fund guarantee, ensuring that even if the parents split, the educational equity for the children remains intact. But more importantly, we are going to dive into the insurance of the premarital state. What happens if you are the one with the assets, and you want to ensure that your foundational wealth is never even part of the conversation? In the next part, we examine the immunity shield and the emerging world of offshore marital trusts, working in tandem with domestic insurance policies. The strategy for 100% wealth retention is complex, but the data shows it is possible. The strategy for 100% wealth retention involves moving beyond basic risk mitigation and into the realm of structured asset immunity. In the high-stakes financial landscape of 2026, the historical trend of wealth loss has forced a paradigm shift where individuals are no longer relying on a single layer of protection. We are seeing the rise of a sophisticated dual-track system, the integration of marital trusts with divorce insurance. This is often referred to as the immunity shield. To understand how this functions, we have to look at the legal concept of the equitable interest. Even if an asset is held in a trust, if that trust was funded with marital income, or if the spouse is considered a discretionary beneficiary, a family court judge may still attempt to reach inside that trust to satisfy a settlement. This is the primary point of failure for most DIY asset protection plans. Let us look at the case study of Chloe, a successful surgeon in San Diego. Chloe entered her marriage with a significant medical practice and several $1 million in real estate. To protect these, she established a domestic asset protection trust, or DAPT. However, during her 10-year marriage, she used the income from the practice, which the law generally considers marital property, to pay the property taxes and maintenance on the real estate held within the trust. By doing so, Chloe inadvertently created a bridge for the court. Her spouse's legal team argued that because marital efforts and funds were used to maintain the trust assets, the community had acquired an interest in the appreciation of those assets. Historically, This is known as the Moore-Marsden calculation in California, a complex formula used to determine the community's share of a separate property asset. In this scenario, Chloe's trust was not a wall. It was a sieve. This is where the divorce insurance policy acts as the secondary containment unit. While the trust might be partially breached, the insurance policy provides the liquid indemnity to settle the community's claim without Chloe having to sell her medical practice or liquidate her real estate holdings. It is a mathematical redundancy. The trust attempts to prevent the legal claim, while the insurance provides the capital to satisfy the claim if the trust is compromised. This is the sophisticated reality of wealth preservation in 2026. You don't just plan for the wall to hold. You plan for what happens when it breaks. Expanding on the concept of offshore marital trusts, we see a historical trend of individuals looking toward jurisdictions like the Cook Islands or Nevis. These jurisdictions do not recognize foreign court orders, meaning a U.S. divorce decree cannot be directly enforced against the trust assets. However, in 2026, the IRS and the U.S. court system have become increasingly aggressive regarding contempt of court charges for individuals who refuse to repatriate funds. This is a high-risk legal maneuver that often results in more harm than good. The modern, safer alternative is the hybrid bridge trust. This structure operates domestically under U.S. law but has a built-in flee clause that allows a neutral protector to move the assets offshore only in the event of a catastrophic legal threat, such as an unreasonable divorce settlement demand. Divorce insurance provides the legal defense fund for these complex structures. The cost of defending a bridge trust in court can be astronomical, requiring specialized tax attorneys and international law experts. Historically, many individuals settle for a fraction of their worth simply because they cannot afford the $250,000 in legal fees required to defend their trust structure. By having an insurance policy that specifically covers the defense of asset protection vehicles, the individual ensures that their legal walls are actually defensible. It is the difference between having a fort and having a fort with a standing army. Now let us analyze the child support delta and the educational equity gap. In 2026, the cost of a 4-year degree at a private university in the U.S. has surpassed $400,000. While child support guidelines are designed to cover basic necessities like food, clothing, and shelter, they rarely account for the soaring costs of higher education or specialized extracurriculars. Historically, when a high-net-worth couple divorces, the children's college funds are often the first casualty of the liquidity crunch. One parent may want to use the 529 plan to pay for their new housing, or the court may count the 529 plan as a marital asset to be split, effectively having the child's educational future. Divorce insurance is now being utilized as an educational continuity bond. This is a specific rider that triggers upon a final divorce decree, depositing a lump sum into a restricted-use trust for the children's education. This ensures that the children's wealth trajectory is decoupled from the parents' legal conflict. This isn't just a social good. It is a vital wealth preservation strategy for the next generation. If a child has to take out $200,000 in student loans because their parents' divorce depleted their college fund, that child begins their adult life with a massive wealth-building deficit. By ensuring the education fund, the parents are preserving the human capital of their lineage. Step by step, we must also look at the premarital state insurance. This is a relatively new concept in the U.S. where individuals purchase a policy before they even get engaged. Think of this as portfolio health insurance. By securing the policy while single, the individual establishes a baseline valuation of their assets that is recorded by a third-party insurance carrier. This creates an objective, contemporaneous record of what they owned prior to the marriage. Historically, the biggest challenge in a divorce trial is proving the inception of title, showing exactly how much was in a brokerage account 10 or 15 years ago. Banks often purge records after 7 years, leaving many individuals unable to prove their separate property claims. The insurance carrier, however, maintains these records as part of the policy underwriting, providing an ironclad evidentiary trail. Imagine if Chloe, before meeting her spouse, had a policy that certified her net worth at $2 million. When the divorce occurs 10 years later, the insurance company provides the certified records to the court. This one piece of evidence could save her $100,000 in forensic accounting fees and protect millions in assets. This is why we say that the value of divorce insurance isn't just in the payout. It is in the documentation discipline it enforces. Furthermore, we need to address the intergenerational wealth transfer. In 2026, the U.S. is in the middle of the Great Wealth Transfer, where trillions of dollars are passing from baby boomers to their heirs. Many parents are now making their inheritance gifts contingent on the heir having a divorce insurance policy in place. This is a form of grandparental risk management. They want to ensure that the family farm or the family business they are passing down isn't lost to a future ex-son-in-law or ex-daughter-in-law. This creates a protected gift environment. The inheritance stays in the family not because of a prenup, which can be contested, but because the insurance policy provides the liquidity to pay off a spouse's potential claim on the family legacy. We have moved from a society where divorce was a rare, shameful event to one where it is a statistically probable financial hurdle. But as we look at the math of 100% wealth retention, a new question arises. What happens when the divorce isn't just a legal end, but a social and professional displacement? There is a reputational cost to divorce that can impact your ability to earn in the future, especially for executives and public figures. In the next part, we are going to dive into the reputational risk and how publicity indemnity riders are being used to protect the brand value of individuals during a split. We will also explore the insurance of the domestic partnership and why the law is moving toward treating long-term cohabitation just like marriage, creating a whole new category of unintentional wealth loss. If you think you are safe because you didn't sign a marriage license, the data suggests you are in for a massive shock. The massive shock many Americans face in 2026 is the legal reality of de facto marriage and the expansion of palimony laws. Historically, the United States maintained a clear distinction between being married and simply living together. You either had the license and the legal protections or you didn't. However, as marriage rates have declined and long-term cohabitation has become the statistical norm for millions, the U.S. court system has adapted in a way that creates significant wealth vulnerability for the higher-earning partner in a non-marital relationship. This is the unintentional wealth loss trap. Let us look at the case study of James, a tech entrepreneur in Seattle, and his partner Elena. They lived together for 12 years. They never married, they never signed a domestic partnership agreement, and they kept their bank accounts mostly separate. However, James paid the mortgage on their shared residence, and Elena stepped back from her career to manage the household and support James's professional growth. In 2026, when they decide to part ways, Elena files a claim for equitable distribution of the home's appreciation and spousal-like support, commonly referred to as palimony. In states like Washington, California, and even parts of the East Coast, courts are increasingly using the committed intimate relationship doctrine. This allows a judge to treat the couple as if they were married for the purposes of asset division. James is stunned to find that his 100% ownership of the home is now legally 50%, and a significant portion of his stock options, earned during the cohabitation, are at risk. Historically, the lack of a marriage license was seen as a shield. In 2026, it is often a sieve. Because there is no formal marriage, there are no formal divorce laws to provide a predictable framework. This leads to longer, more expensive, and more volatile legal battles than a standard divorce. Divorce insurance, or more accurately relationship dissolution insurance, has pivoted to cover these exact scenarios. These policies provide a cash benefit for individuals in long-term cohabitation who face equitable claims from a former partner. The data suggests that without a formal agreement like a cohabitation contract, the legal fees for James to defend his pre-existing wealth could easily exceed $150,000. The insurance policy acts as a legal defense indemnity, providing the funds to litigate these complex, often vague claims of implied contracts. Expanding on this, we must look at the reputational risk and the publicity indemnity rider. For high-profile individuals, executives, or public-facing professionals, a divorce or a messy domestic split isn't just a private matter. It is a brand liability. In 2026, a single viral social media post from a disgruntled ex-partner can trigger a morality clause in a corporate contract or result in the loss of a major sponsorship. Historically, we have seen public figures lose 40 to 60% of their future earning capacity due to the negative PR of a contentious split. Imagine a character named Sarah, a high-level influencer and brand ambassador. When her relationship ends, her partner threatens to release private communications or make public allegations that could destroy her reputation. This is reputational extortion. Divorce insurance is now offering reputation management riders. This feature provides a pre-funded retainer for a crisis PR firm and a specialized legal team to secure non-disclosure agreements and cease and desist orders within hours of a conflict arising. By protecting the intangible asset of Sarah's brand, the insurance ensures that while her current net worth might take a hit, her future wealth-generating engine remains intact. Step by step, we must analyze the social displacement cost. When you lose a relationship, you often lose access to a professional and social network that was tied to the couple's status. For a luxury real estate agent or a private wealth manager, this network erosion is a direct hit to their bottom line. The historical data on wealth loss indicates that individuals often see a 20% dip in their professional revenue in the 3 years following a high-conflict dissolution. This isn't just because of emotional stress. It is because they have been socially deplatformed. Modern insurance products are being designed to offer business interruption benefits for individuals whose income is heavily dependent on social and professional standing, providing a monthly stipend to offset the temporary loss of clients or networking opportunities. This leads us to the shadow value of domestic labor. One of the most significant shifts in U.S. family law between 1980 and 2026 has been the way courts quantify non-financial contributions. Historically, if you were the breadwinner, you kept the money. Today, the court views the home manager as a silent partner in your career. If your partner stayed home to raise children, they are viewed as having enabled your success. This contribution theory is the engine behind large alimony awards. Divorce insurance acknowledges this as a quantifiable liability. If you are a high earner, your liability exposure grows every year your partner stays out of the workforce. Actuaries now use career displacement tables to calculate the potential rehabilitative support you would owe, allowing you to pay a premium that reflects this growing risk. We also need to address the cross-border wealth leakage. As more Americans become digital nomads or work for international firms, the jurisdictional risk has exploded. If you lived in New York but spent 6 months a year in a jurisdiction with more aggressive common law marriage rules, which law applies? The conflict of laws is a goldmine for attorneys and a nightmare for wealth preservation. Divorce insurance in 2026 often includes a jurisdictional choice of law defense fund, ensuring that you have the capital to fight to have your case heard in the most favorable venue. But what about the internalized loss? We have talked about houses and stocks, but there is the tax basis of the soul, the loss of time. If a legal battle drags on for 5 years, those are 5 years where your capital was unproductive because it was frozen or tied up in litigation. The opportunity cost of conflict is the greatest hidden tax in America. If James had $2 million in assets tied up for 5 years, at an 8% annual return, the conflict tax cost him over $900,000 in lost growth. Divorce insurance provides a fast-track settlement incentive. By providing an immediate payout to the other party, the insurance can buy the peace, allowing the policyholder to unfreeze their assets and get back into the market years earlier than they would through the court system. As we look at the historical trajectory of wealth loss, it is clear that the U.S. is moving toward a de-risked marriage model. The romantic notion of what's mine is yours is being replaced by the pragmatic reality of what's mine is insured, and what's yours is accounted for. But there is one final frontier we haven't touched: the world of algorithmic matching and prenuptial pricing. In the next part, we are going to explore how AI in 2026 is being used to predict the success probability of a marriage before the first date even happens, and how insurance companies are using this data to set your premiums. We will look at the marital credit score, and how your past relationships are now a permanent part of your financial record, influencing everything from your ability to get a mortgage to your premium on a divorce insurance policy. The future of your wealth is being decided by an algorithm, and you need to know how to hack the system. The intersection of big data and matrimonial stability has created a new financial reality in 2026, known as the marital credit score. For decades, the insurance industry has used actuarial science to predict when you will die, when you will crash your car, and the likelihood of your home flooding. It was only a matter of time before these same algorithmic models were applied to the most statistically volatile event in an American's life: their marriage. Today, insurance providers are utilizing advanced machine learning to analyze what they call relationship risk vectors. This is not about love. It is about the cold, hard probability of wealth fragmentation. Imagine a character named Alexander, a 34-year-old financial analyst in New York City. Alexander is a meticulous planner. He has a high credit score, a diversified portfolio, and a stable career. However, when he applies for a high-limit divorce insurance policy in 2026, He is shocked to find his premiums are 40% higher than his peer, Brandon. The reason lies in Alexander's digital footprint and historical data. The algorithm has flagged that Alexander has had 3 long-term cohabiting relationships in the last decade, all of which ended around the 3-year mark. Statistically, the algorithm views this as a pattern of short-term stability, followed by high-velocity dissolution. To an insurer, Alexander is a high-risk driver in the lane of matrimony. Historical trends show that insurers are now scraping data that goes far beyond financial statements. They are looking at social media sentiment analysis, geographic move frequency, and even the financial compatibility of a couple's combined data sets. If Alexander's partner has a history of high consumer debt, while Alexander is a hypersaver, the wealth friction score of the relationship spikes. The insurance company sees this disparity not as a personal quirk, but as a leading indicator of future legal conflict. In the US, the #1 cause cited for divorce is financial stress. By quantifying that stress before the marriage even begins, insurance companies are effectively pricing the risk of your lifestyle. This algorithmic approach has led to the rise of risk-adjusted premiums for marriage. Just as a driver can lower their auto insurance rate by installing a telematics device that tracks their braking and speed, some divorce insurance policies in 2026 offer lower rates if the couple agrees to financial transparency monitoring. This involves linking their joint accounts to an AI-driven conflict detection software. If the software detects spike spending or secretive asset movement, the red flags of dissipation we discussed earlier, it triggers a notification or a mandatory mediation session. This is the ultimate wealth protection hack. By catching the financial markers of a failing relationship 18 months before the legal filing, the insurance company can intervene to preserve the marital estate, thereby lowering the potential payout and, consequently, your premium. But the implications go deeper than just premiums. We are seeing the emergence of the uninsurable candidate. Historical data from the mid-2020s indicates that individuals with a marital credit score below a certain threshold are being denied coverage altogether. This creates a financial ghetto for those with high conflict histories. If you cannot get divorce insurance, you cannot get a hedge for your assets. This is leading many high-net-worth individuals to refuse to marry someone who cannot qualify for a top-tier insurance policy. In 2026, being insurable is the new social proof. It tells your partner and their family office that an objective third-party algorithm has calculated your success probability and found it high enough to bet millions of dollars on. Let us analyze the case study of the algorithmically optimized prenup. Historically, prenuptial agreements were drafted by 2 opposing lawyers, often creating an adversarial environment before the wedding. In 2026, insurance companies are providing standardized algorithmic templates. These are pre-vetted legal frameworks that have a 95% enforceability rating in U.S. courts. If a couple uses the insurance company's template, their premiums are slashed because the insurer knows exactly how the asset division will play out. This removes the legal wild card from the equation. It turns the prenuptial process from an emotional negotiation into a standard terms of service agreement. Step by step, we have to look at how this data impacts your collateral financial life. In 2026, mortgage lenders and business loan officers are beginning to ask for your marital stability rating as part of the underwriting process. If you are a business owner seeking a $10 million expansion loan, and you are in a high-risk marital profile without insurance, the bank may view your business as having an unhedged 50% liability. This could result in higher interest rates or a denial of credit. Historically, we have seen businesses collapse because a sudden divorce filing triggered a call option on a bank loan. Divorce insurance solves this by providing the bank with the loss payee status, ensuring the loan is covered even if the owners split. We must also address the privacy paradox. To get these lower premiums and higher protections, you are essentially surrendering your financial privacy to an insurance carrier. The data shows that while most Americans value privacy, they value wealth security more. The historical shift from 2020 to 2026 has been a move toward radical transparency in exchange for systemic stability. By allowing an algorithm to monitor your marital health, you are betting that the machine can save you from yourself. This brings us to the concept of the smart settlement. When a dissolution does occur in 2026, the insurance company's AI doesn't just cut a check. It runs thousands of simulations to determine the most tax-efficient way to divide the assets based on current market conditions. It might suggest that Alexander keeps the primary residence but offsets the equity by surrendering a specific portion of his Bitcoin holdings, while the insurance payout covers the tax gap created by the trade. This algorithmic mediation is reducing the time for a divorce to be finalized from 18 months to 18 days. The time value of money saved here is astronomical. But as we master the algorithms and the insurance writers, we have to face a final sobering reality. All the data, all the insurance, and all the smart contracts in the world are designed to protect the quantity of your wealth. But they cannot protect the utility of it if you are left in a legal and social vacuum. There is a final boss in the history of wealth loss that most people never see coming until it is too late. It is the post-divorce tax and inflation spiral that hits individuals who have won their settlement but lost their lifestyle. In the final part of this masterclass, we are going to synthesize everything we have learned into a total wealth immunity blueprint. We are going to look at the post-game strategy, how to rebuild a multi-million-dollar net worth in half the time using insurance-linked reinvestment. We will reveal the hidden math of how some people actually come out of a divorce financially stronger than they went in. And finally, we will answer the most controversial question of all. Is the traditional American marriage becoming an obsolescent financial asset? The conclusion of this deep dive will change the way you look at your partner, your portfolio, and your future forever. The blueprint is ready, and it is time to build your shield. To build your shield, we must first confront the post-divorce tax and inflation spiral. Historically, many Americans believe that once the judge signs the decree, the financial bleeding stops. In reality, for many, the decree is simply the start of a new, more insidious phase of wealth erosion. In the year 2026, the cost of living for two separate households is statistically 35% higher than the cost of a single shared household. This is the efficiency gap. When you lose the ability to bulk buy resources, share utility base rates, and split property taxes, your dollar has less purchasing power. This is why the Total Wealth Immunity Blueprint starts with the reinvestment of the indemnity. Imagine a character named Catherine, a high-performing real estate developer in Phoenix. Following her dissolution, Catherine receives a $250,000 payout from her divorce insurance policy. While many would use this cash to furnish a new apartment or cover immediate lifestyle gaps, Catherine follows the blueprint. She understands that her biggest threat is the loss of compounding years. She treats the insurance payout as recovery capital. Step by step, she uses $100,000 to max out her catch-up contributions to her solo 401k and HSA, effectively lowering her taxable income during a year when she has lost her joint filing status. She puts the remaining $150,000 into a high-yield, tax-advantaged private placement fund. By doing this, Catherine uses the insurance to effectively cancel out the 5 years of growth she lost during the legal battle. Historically, those who reinvest their insurance proceeds immediately have a 70% higher chance of returning to their pre-divorce net worth within 36 months. We must also look at the case study of the post-divorce mortgage pivot. In 2026, the housing market remains a primary vehicle for American wealth. However, a divorced individual often struggles to qualify for a new mortgage on a single income, especially if they are paying or receiving support. The blueprint utilizes a concept known as support grossing up. Insurance companies in 2026 are partnering with specialized lenders to provide mortgage guarantee riders. If Catherine's income is temporarily unstable post-divorce, her insurance policy acts as a co-signer or provides a cash collateral account that the bank can hold. This allows her to secure a new primary residence at competitive rates, preventing her from being stuck in the rental trap, where she would be paying off someone else's mortgage while her own capital sits idle. Next, we analyze the hidden math of the lifestyle reset. There is a psychological and financial phenomenon where individuals try to maintain their married standard of living on a single income to prove they are okay. This is a recipe for long-term insolvency. The Total Wealth Immunity Blueprint suggests an immediate 20% lifestyle deleveraging. By proactively downsizing before the court orders it, an individual preserves their liquid capital. Historically, the data shows that those who downsize voluntarily in the first 6 months post-filing retain 40% more of their total net worth over 5 years than those who wait for a court-mandated sale. Divorce insurance provides the transition stipend that makes this deleveraging less painful, covering moving costs and the quiet period of professional restructuring. But is the traditional American marriage becoming an obsolescent financial asset? To answer this, we look at the rise of the strategic partnership model. In 2026, we are seeing a historical shift where high-net-worth individuals are treating marriage more like a joint venture with a fixed duration and clear exit triggers. This sounds cold, but the statistics suggest it is the only way to survive the modern economy. By integrating divorce insurance into the very foundation of the relationship, the financial risk of the partnership is decoupled from the emotional connection. This allows for more honest communication and less resentment. When both partners know that their floor is protected by a third-party insurer, the fear of losing everything disappears. This actually leads to a higher statistical probability of the marriage surviving, as financial stress is the primary killer of long-term relationships. The final piece of the blueprint is the intergenerational shield. We have to look at how wealth is passed down. In the US, the divorce tax doesn't just hit you, it hits your heirs. If your estate is halved by a divorce at age 60, your children lose out on half of their potential inheritance and the decades of growth that money would have generated. By maintaining a divorce insurance policy even into later life, you are essentially buying a legacy insurance policy. You are ensuring that the family's total capital remains intact, regardless of the marital status of the patriarch or matriarch. This is how the ultra-wealthy have stayed wealthy for centuries, by never allowing a personal event to trigger a mandatory liquidation of the family's core assets. Let us look at a final imagine-if scenario. Imagine if every marriage license in the United States came with a mandatory low-cost insurance premium, much like the mandatory auto insurance required to drive a car. The social friction of divorce would plummet. The legal backlog in our courts would disappear. The middle-class wealth erosion that has defined the last 40 years of American history would be halted. We would move from a society of accidental poverty to one of insured stability. As we conclude this deep dive masterclass, you must realize that the historical trends we have analyzed are not just numbers on a page. They are the blueprints of your future. You have seen how the legal friction coefficient can eat 20% of your worth. You have seen how the tax trap of Section 1041 can leave you with a ghost asset. You have seen how the algorithm is already pricing your risk. The question is no longer whether divorce insurance is a good idea. The question is whether you can afford to operate in the 2026 economy without it. The concept of wealth in America is changing. It is no longer just about how much you make. It is about how much you can defend. Marital dissolution is the single greatest unprotected risk in your portfolio. By applying the principles of the Total Wealth Immunity Blueprint, leveraging insurance, understanding the tax code, and using algorithmic tools, you can ensure that your financial story is one of growth and resilience, rather than one of loss and regret. We have covered the history, the math, the law, and the future. But there is one final emerging trend that is starting to disrupt even the insurance industry itself. It is the rise of decentralized marital pools, where communities are bypassing traditional insurers to protect each other's wealth. In our next series, we will dive into the world of private wealth collectives and how the most elite families in the world are using peer-to-peer indemnity to stay off the radar of the IRS and the family courts. The game is evolving, and the next level of the shield is already being built. Are you ready to enter the private sector of wealth protection? The data is waiting.